Hey everybody, welcome to the game plan. My name is Gareth Soloway, Chief Market Strategist here at VerifiedInvesting.com. So we have a lot to discuss. It's been a wild week in the markets, Fed decision, earnings announcements coming out. And again, the markets, and this is the tricky thing, the NASDAQ especially is making a bear flag on the daily chart. And again, I'll show you this pattern in just a minute. And what it tells us is there's more downside coming with a high probability. All right, so let's get right into the charts. Follow me over here to the pre-market action. Today is triple witching, by the way, so there'll be a lot of volume as these options. Again, it's a triple witching, so that's 3 different sets of options. Contracts are going to be expiring today, but nonetheless, we are looking at an S&P that is lower today again. So we've seen a couple bounces, attempted bounces, and ultimately the markets keep crapping out and not able to hold any significant move. Here you can see again, this was yesterday, right? So we opened yesterday lower. The markets ultimately rallied up. Then they came back in and chopped sideways into the close. This was yesterday after hours, sideways analysis or sideways action. And then we had a dip here in the early pre-market this morning, consolidation, and another drop. Now, I want to show you a couple things here. Couple things of interest. Notice how you have this low right here, all right? And then look at how, if you drag that line across, look at how the market was consolidating. So again, it hit here, bounced, came back, bounced into yesterday's open, came down, went sideways, came down here, broke, and then look at how that becomes resistance on the market. So again, you can use these levels to kind of help you predict where the market will most likely go, support and resistance. Honestly, that's essentially what I trade with. I keep it super simple. When I show you guys these charts, always remember, I don't have 1,000 different indicators on here. It's about as simple as can be. Candlesticks, and that's it. Occasionally, I'll throw in moving averages, RSI, just to take a peek. But in general, everything you need to make educated, high probability decisions are on the charts. And that's it. The candlestick charts, keep it simple, I always say. All right, so let's jump into a couple other things here. I do want to go over the daily chart of the S&P here. We know that we've had this bounce right here on the SPY, but overall, again, nothing significant here. It hasn't been a robust bounce. In fact, one of the things that I use as an indicator of the size of a bounce, in general, after a big drop, you get at minimum a 382 Fibonacci retrace. If we look here, you haven't even gotten up to that Fibonacci 382 retrace. That tells you how weak the market is, and now we are starting to turn back down. The question I have for next week is, do we break this line? If we break this line, the next big leg comes in, and ultimately I think we go down to August 2024's low. That will be your next significant level. Now, one of the things I was talking about here was this pattern formation. So this is the QQQ, the NASDAQ 100, and we know this is the tech-heavy index. We're basically the 7, the Magnificent 7. You can throw in Tesla if you want, but ultimately these stocks make up about 50% of this index. We know that the 2022 low here, the bear market low, it's connected perfectly to this low here in October of 2023, the low in August of 2024, and right here we broke. Okay, now you broke and you did confirm, which means this is now major resistance on the NASDAQ 100. Now, if I go over to the big board here and we discuss what pattern formation this is, and I always try to kind of teach you guys as we go so you guys know all that's in here in my head that I've learned over many years of trading. This down move, and then this is the pattern formation. What type of pattern formation is that? That's what we call a bear flag in technical analysis. Now, can bear flags fail? Absolutely. I've seen a lot of them fail. But if you looked at 1,000 of these, generally about 70% or 700 of these would play out like this. And so again, as a trader that ignores emotion, tries to limit any sort of personal feelings I have for any sort of investment, I go with the probabilities like a casino, right? We're just playing the odds over and over and over again. And as long as we stay below this line, the odds favor this pretty significant move to the downside. In general, I've noticed that these type of patterns have a tendency to do what's called a measured move. What's a measured move? Well, notice how it's a very sharp drop from here to here. All right, so what that tells me is that there's a decent likelihood we will replicate that distance wherever we top out. If it was here or if we go over here, that distance then will be replicated out to the downside. And again, that puts us down significantly over 20% on the NASDAQ 100 if this measured move bear flag plays out. And we could be talking about this type of drop within months. I mean, again, if we look at this took about a 1 month period here, even a little less. Now let's say we consolidate for I don't know, let's say another week. Let's just say it's chop. So you get a couple weeks of chop, and then that next leg takes you about a month further out. That, again, is not long to see the NASDAQ potentially from the February highs down potentially 20%. So just something to keep in mind here, folks. Again, this is probability-based trading using the charts to our advantage. And by doing that, again, we just try to put ourselves in a position to win a majority of the time. We know we're not going to win all the time. That's not even in question. There's no trader that does. But we want to win a high probability or percentage of the time. All right, speaking of which, looking at Apple, look at the pattern on Apple. It's almost identical. The only difference is we have a head and shoulders pattern here. Now, again, a head and shoulders, much like what I just talked about, can be figured out in terms of a target. You take your high of the head, you drop that line exactly down to what's called the neckline. This is called the neckline, right, of the head and shoulders. You take that same distance, and from the break point, that is your downside target. So basically, we're talking sub 180 on Apple just to complete this pattern formation here, or the head and shoulders. Now, what's interesting here is you have the same sort of breakdown, right? You broke the support level, just like the NASDAQ 100, right? If we flip back to the NASDAQ, here's your support level on the NASDAQ, broke, right? And look at the sideways chop, the bearish consolidation that's occurring. Now, again, is it possible that this could fail and magically Apple could rebound and get back above this level? Absolutely. But until it does, it favors that downside cycle move, which takes us down to sub 180 on Apple. Now, we do have some stocks moving in the pre-market. Here is Micron. Micron rallied initially on earnings, and look at this. I mean, this just shows you what type of market we're in, guys. It's so interesting here. So I have seen so many stocks, including Broadcom just a few weeks ago, that initially had a huge rally when they released earnings, and then the next day, Broadcom lost almost all of its gains. Well, here we have a scenario where Nike initially popped on earnings, now is negative, and what we're looking at right here on the chart, we can see Micron popped, and by the way, if we go to the daily chart, where did that go? This trend line. Look, high pivots right here. This is a trend line I highlighted yesterday. It went right to the 109 level here. I didn't have the guts to short it because it was such a small move up. It was only about a $6 move from the close yesterday. But either way, it hit it and it got rejected. And now look, on the intraday, we're now coming down and we're sub $99 a share after being at 109 in the after hours, almost 110. Now again, look at the pattern, right? Down move, inside bar. So even patterns can work pre-market if you have volume. So there's volume on Micron because they reported earnings. So there's a lot of pre-market action. And so this would be a valid pattern to look at and say, okay, it likely is going to go lower here. But again, if it didn't have any volume, we wouldn't really care so much about the pre-market. Now, if we go to this chart, where is the support level today? There's a couple that I'm watching to potentially day trade with the Apex Live day trading room. Gap fill at 89 would be fantastic. And then the lower trend line here at 84. Both of these would be high probability for day trade bounces. Swing trade, I don't really like this pattern. Again, down move, it's not really the best of bearish patterns. But again, anytime you have a big move down and then sideways chop, it's essentially winding the spring again, and it generally goes in that same direction. So again, I wouldn't be a swing trade buyer at these levels, more just a day trader or maybe overnight. Maybe if I thought it was a really good setup, overnight would be okay, but that's about it. FedEx is getting crushed here, guys. So FedEx essentially, and by the way, I mean, a lot of these companies, like Nike initially popped and then was like, yeah, so we beat earnings, but tariffs are going to crush our business, essentially. That's what they're saying. And then a lot of these companies, whether it's really tariffs or their businesses are just slowing down due to consumer spending, who knows, but they're blaming tariffs, a majority of it. Granted, consumer spending is being talked about. But FedEx down again, look at this, down from a close yesterday, basically at 246 to 222, approaching 10%. And then if we go to this chart, look at this, guys. This is really cool. We had this upsloping parallel. It broke, and then look at how it retraced, and now it's continuing lower. That's very common in technical analysis. Now, I do have a first support level here at around 216. This is very close to where current price is trading. So again, 216 right here will be a level I'm watching. It's kind of what we would call a gap window. You can even extend this out to right here, this low here, and here. Now, that again would just be a quick trade because it could fill the gap, which would be another major level at around 204. So these are my two trading levels for the day on FDX. And again, it is already down. It's basically trading right here in the pre-market at 222. So it's very close to that first level. Nike, you can see the initial pop on Nike, and then it just withered and died, and it just continues to grind lower. We're now at below $66 a share on Nike, and Nike was already beaten down. Look at this. It's already way down on the charts. And this is where it gets interesting, right? Because you technically do have a level here where you connect these lows, but this is at 68. Price is already below that, which means we can't trade that 68 level. We actually have to zoom out and start saying, okay, well, where's our next big support on Nike? And honestly, at this point, you got to start looking at the COVID low. The COVID low, which is right around $60.75, that's probably the next big level that this stock will have, and that might be a swing trade. That's such a significant pivot low on the Nike chart that we've got to start thinking that not only a day trade if it hit it today, but maybe even a swing trade, as again, how much lower can Nike go? I mean, I'm sure if we get in a real bear market, it's going to go much lower, but at least for a swing trade bounce, you would assume the COVID low would have a lot of buyers attacking price. All right, so again, guys, earnings. We saw the Fed again, and again, I think the Fed was interesting because the Federal Reserve on Wednesday afternoon basically highlighted the uncertainty of inflation due to tariffs and then also the economy slowing. But they also said we're only going to cut 2 times this year, and the market, as I showed you yesterday in the game plan, it's already pricing in a 3rd cut. And we know Trump is out there tweeting already multiple times, the Fed needs to cut rates, the Fed needs to cut rates. So this is where you're going to get in this back and forth, which is going to make the markets even more uneasy when they start to have this kind of back and forth between the Fed and the president. Then throw into that the fact that as the economy slows, and I've said this from the very beginning, Doge is a great idea. We got to cut out the junk. We got to do it in the right way. I'm not necessarily in agreement with how it's being done. I think it could be done with softer gloves on to not make it so hurtful to people that are getting fired and laid off. But the point being is that you got to cut out the waste. The problem is it's easy to say when you have a bull market and you have an economy that's growing. I don't believe that the politicians have the stomach for it when you get into a recession, which I think we'll be in by later this year, and then you're still making cuts. I think it will stop, and then again, fiat currencies start to get printed again. We know how this rigmarole goes. All right, let's go into Bitcoin, guys. We'll take a quick look at Bitcoin here. Bitcoin on the chart, I like to use the Coinbase chart just because, again, it has a lot of volume there. We could see again yesterday, Bitcoin fell down, basically giving back the prior day's gains, and it's down a little bit today. So again, I would just point out what type of pattern formation in the short term is this. If we bring up our arrows, you have your down move in the short term and inside bar. That leads me to still believe that we're headed down to 74 to 72,000 on Bitcoin. All right. So again, doesn't mean we can't reattack resistance up here, but I would continue to be bearish near term on Bitcoin unless we confirm above 92,000. And then even then, we still have to attack the all-time high at 108 to 109. But right now, this pattern is a pattern that I trade all the time, and it is a bearish pattern. Speaking of bearish patterns, over the last few sessions, we've talked about this, right? So again, let me go to the big board to dissect this so we get a little break from the screen there. But basically what we have here is something that I've talked with you guys literally since day one, right? So one, we had the topping tail right here, which is a bearish reversal signal. Price fell into the support line. We can see the support from here to here to here and right to here. It then went like this, which again is a pattern that, I mean, how many times have I shown this pattern today alone in this game plan episode? And then look, price is starting to break to the downside. So again, the key is, and many people always say, well, why do patterns repeat? I mean, why has a bear flag worked for 100 years in trading? And the answer is very simple, is that what is creating this chart? Think about it. What is creating this chart? Humans, right? Buyers and sellers. And now humans We all tend to get fearful at the same time. We all tend to get greedy at the same time. Emotion is what rules humans, right? That's what we do. That's why I try to be as robotic as I can, because then I don't make decisions that everyone else is making on emotion. I think logically and use the charts. And so that's why bear flags 100 years ago, or even 1,000 years ago, you go to ancient Rome or wherever else, there was the same sort of things when they were doing commodities and such like that. The same patterns would form, and then you get your downside move. And again, it's not to say that they're not infallible. These do fail, and they do fail, 30% of the time, but it's about playing the odds. Be the casino over and over again, knowing that, yeah, you're going to take some losses, but you just want to win a majority of the time. And that's the key there. So again, just looking at natural gas, it was down a little bit more. It's bouncing a little bit here today, but you can see the pattern is trying to play out to the downside. I still have my ultimate target around $3.40, $3.30 on nat gas. All right, let's take a look at oil, then we'll go into gold. Oil had the bounce, so I've been calling for a little bit of a bounce here over the last week or two after we hit into this level. We've gotten a bounce, but again, look at how weak that bounce is. I mean, again, I said upside maybe to $70. We haven't even gotten close to that yet. I still think it's possible, but time is running out, right? The bear flag is forming. Again, another example of a down move, inside bar consolidation, kind of winding the spring for the inevitable, likely downward move. So again, just be aware. Sideways to chop, maybe still touch 70, 70 and a half, but eventually the analysis right now, obviously subject to change if the chart changes, but right now probability favors a downside move. Now, let's move on to gold. You guys know I am bearish on gold off of these highs. As of now, it has stalled out. Classic channel. You have your high end of your channel here. Bullish sentiment piercing 3,000. This is an even number play as we refer to it in the services here at Verified Investing. Only a little bit of a pullback thus far, meaning there's still a lot of bulls that are buying up here. Even though I'm mid to long term very bullish on gold, because I still think the government and global governments will go back to the printing presses as soon as there's hardships, I'm still in a belief that we're due for a pullback. At minimum, I think 29.50 right here would be a level to watch. And then lastly, we have silver here, broke out above resistance, goes up, couldn't even get to the next resistance here, but it's now coming in. This will be the big test for silver, right around 32.75. That technical level will be support. Again, will it hold? We're going to have to wait and see. I certainly don't have the guts to be buying silver at that level, I'll tell you that much. It's not down enough. It's not been decimated enough. I really like extremes into support or extremes into resistance for those highest probability and best reward to the risk that I'm taking type of trade setups. All right, guys. So listen, next week we have a lot of economic data. Again, it'll be a little lighter on earnings next week as we go into these final couple weeks of the month of March and then the first week of April. Then once we get into mid-April, guys, earnings season starts up again. We go into the financial earnings, then we get into tech earnings, and it gets wild again. But in the meantime, tariffs, inflation data, economic data, those are going to be the forefront that we have to pay attention to. And ultimately, I pay attention to that, but then I also use the charts, and that's the main guide to whether I'm going long or short. All right, thank you guys for supporting us here at Verified Investing. Data-driven, analysis-based, that's what it is. Get the emotion out. You'll trade 100 times better, I promise you. Have a great rest of your day and weekend. Talk to you soon. Take care.